are live, another version of YouTube Live on a Monday, 3 p.m. Pacific Standard Time. A big week in mortgage. And so I'm going to jump into why this week is such a big week and expect it to be more volatile than last week. Can you believe I put this plant back here? I mean, it looks kind of nice. It adds a little bit of flavor, right, to my surroundings. But 5 uneventful trading days last week. This week, we've got a lot of data coming out. We got a lot of things going on. So expect more volatility in the mortgage market. I'm going to run through some quick questions because I want, while you're on here live, ask away with questions. I will, in most cases, get through every single question. Even the questions that you think I wouldn't want to answer, it's like there's no question I won't answer. So fire away. Like, ask me where I got my shirt from. It could be anything. And let's have some good dialogue around mortgage, the real estate market, what I think's going to happen for first-time home buyers in 2023, what I think's going to happen in different markets, for whatever the heck you want to ask it here, because I think it's the best place where you're going to get like an honest, straightforward, and quick response versus posting something, somewhere on the interwebs. Someone might respond to you a week later, or, God forbid you search it yourself and you find the wrong answer or a 6-year-old answer. So Joey G, let's go. Thanks for joining. Appreciate you, brother, all the way from Oklahoma City. My buddy Kevin Hawthorne, another loyal friend of the channel, from Lakeland, Florida. John Isola, thanks for joining. Mortgage people love to jack up fees like title insurance. Title insurance is what you would refer to as a third-party fee. While I don't have any control over what title companies charge for title insurance, I can tell you that the best of the best in the mortgage industry, the broker world, is doing what they can to vastly reduce these title fees. We've got something going with United Wholesale Mortgage where title insurance, you can get a waiver and pay significantly less for your title insurance. So if you haven't talked to a mortgage broker, I suggest you do. If you want to connect with me and my team, since we're licensed all across the U.S., all you got to do is go to greatmortgagebroker.com. But if you're dealing with a lender who's charging a bunch of excess fees, you're not working with us. So greatmortgagebroker.com. Solve your problem, John. You are welcome. Michelle Huston. How long does it take for a VA appraisal in Sacramento? Why are they so slow? Appraisals have been coming back very quickly. So I don't know what the holdup may be, Michelle. If it's in Sacramento and it's not like super rural parts, I can't imagine it taking more than 10 or 12 days. With VA appraisals, it's a little different process than it is with conventional, where you're going to have, to order it through the VA portal, and you don't have as much control over it as a lender as you would if you're dealing with a appraisal management company on a conventional deal or FHA deal. But I wonder what lender are you using. If you don't want to share it here, feel free to ping me privately. Shoot something over to team@mtmg.com. I'll answer any questions, regardless of the fact that you're in process working with somebody else. We can still hopefully help you and lead you in the right direction. Joey G, thanks for analyzing the Fannie Mae changes for all of us on the channel and on ORAT. No problem. I actually just sent over something to Mike, One Rental at a Time. If you're not subscribed to One Rental at a Time and you're a real estate investor or thinking about investing in real estate, I highly recommend it. My buddy Mike Zuber and I talk every single week. That video goes on his channel, One Rental at a Time, but he also talks to 14 other professionals, whether they be real estate agents, commercial folks, investors, wholesalers, all kinds of different experts from across real estate. And so, yeah, shout out One Rental at a Time. Hi from California. What part of California are you in, AG84? Let me know. I will come back and answer any and all questions. So keep firing the questions away. What I want to talk about in regards to this week in mortgage, like I said, last week, 5 uneventful trading days, boring, snooze fest. Rates, if you look at Mortgage News Daily, 6.2 as a daily average nationwide, give or take every single day, right? This week, Tuesday, we've got the home price index. That's Case-Shiller that puts out their HPI home price index. That comes out on Tuesday. That could have an effect on mortgage rates. One of the biggest things that's going to have effect on mortgage rates. If you don't know, now you know. The Fed's next meeting is tomorrow, January 31st, and Wednesday, February 1st. They get together those 2 days, and on February 1st, they have the press conference. They release, hey, we're going to raise the Fed funds rate a quarter, and then they talk. And like I've said on here multiple other times, what they talk about is almost always more important than what they do. The 25 basis point hike is almost a certainty now. It's got to be 90 some odd percent that believe it's going to be a 25 basis point rate hike. They'll talk about what they're going to do in March because they meet again in March. I think it's like the 24th and 25th or 25th and 26th. That's the next Fed meeting. A lot of people are predicting 25, 25, and then pause. Other people are predicting maybe it's 25 and then pause for the rest of the year. If they do 25 and then they pause, or if they do 25 and they talk about a pause, it's going to have a downward pressure, a good effect on mortgage interest rates. So stay tuned for that, which is Wednesday. Mortgage application data comes out. The ADP employment reports and JOLTS reports come out on Wednesday. Thursday, initial job claims, job cuts report, job reports strategy, and then more job stuff. The BLS jobs report comes out on Friday. So when data comes in that, gives us signals of how economically stable we are and where the economy's headed and whatnot, it has an effect on how mortgage bonds are traded, thus affecting mortgage rates either positively or negatively. So all those things have the ability to, I'm not saying they will, but they have the ability to have an effect on mortgage interest rates. At the top of the list is that press conference on Wednesday, where if you're in mortgage or in real estate and you know how these things work, when those press conferences are going on, you can watch mortgage-backed securities trade and you can watch rates either start to trend up or down. I mean, it could be that doesn't have a big effect on interest rates either, but it certainly can. So anyhow, that's all the stuff that's coming this week in mortgage. I've got some other updates as well that I'll get to in a minute. Let me check on comments and I'll jump back in and tell you what I think about first-time home buyers, the tightening of the automated underwriting systems, and more. Yes, we can help with HELOCs, AG84. I will tell you, if you bank with a small bank or a local credit union, try them as well. I'm the first to say that I'm not necessarily the one-stop shop for every single loan there is out there. If you're looking for a mobile home that's inside of a mobile home park, not your guy. If you're looking for, really fancy, exotic bridge loan products, not your guy. Really good at the stuff we do, but honest enough with my clients, with my business to tell you if it's a HELOC, I've got access to them, and I can certainly show you the ones that we close in 5 days. But you may be able to get better terms at a local credit union or bank. Usually the small ones have great terms. So anyhow. What's up, Radoni? Bring on the Fed, baby. Yes, sir. For you and other investors and people who are rooting for interest rates to come down, so you can buy more with cheap debt, and it's probably going to have a upward pressure in values and the stuff you own already. It'll be interesting to see what the Fed says. I think they're going 25 this round, and then they're they're going to get their paws on and see what all these hikes over the last 12 months, the impact they'll have. Because if they're smart and they listen to their boy Matt the mortgage guy, they'll realize like you can't continue to hike and think that you're going to see all the effects of all the hikes immediately. You know, there's hikes that we've already had that won't necessarily affect the market for 3 to 6 months, right? Like you don't immediately see an effect in real estate prices the day that mortgage rates go up a half a point, right? It takes a little while. So anyhow, we gonna see, that's for sure. Jay Homeboy, this is an amazing question. And so I'm going to dig into this one because I think it's a good one. More and more people I'm talking to in and around Northern California where I'm at are looking at new builds. I won't name any builders, but almost all of them have some sort of affiliation with a lender. A lot of them own their in-house lender. So that's a whole different story. But whatever the case, they're going to have homes for sale. They're going to say, use our in-house lender, get a $10,000 credit. Use our in-house lender, get a $15,000 credit. And part of me understands why they do it. They want to have control over the whole transaction. But what I've seen lately, and it's wild. It is wild. I reviewed something recently. I got to be careful not to show this. It's actually still sitting on my desk. All right, not going to name names. I'm going to play nice today. We were $24,000 better than this lender, who happens to be owned by the builder. So it's basically the builder's lender who, in my opinion, structure it like this on purpose, where they add a bunch of margin to the mortgage and make it $24,000 more expensive just to be able to tell you, we're going to give you a $15,000 credit if you use ours. And then the homeowner, you get stuck in a situation where you're overpaying by $9,000. If I've got something for sale for $29.99, sweatshirt, $29.99, and Kohl's advertises it for $100, but says, I'm going to give you $50 off if you come into store today. Well, you're better off buying it for me for $29. It's the same thing. Just because they're offering you a $50 credit doesn't mean it's better, because they're starting at $100 and giving you a $50 credit for the same sweater at $50. I got you for $29. So that's what happens in some cases. In other cases, I just looked at another one, and I'll give the example on the other side where we were like neck and neck, same loan. If they used the builder's lender, they got $7,500. I told the borrower straight up, man, we're better by $500, which is the same for all intents and purposes. If they're offering you $7,500 and you trust that they're going to deliver on what they promised and they can get you to the finish line, well, you'll save $7,000 working with them. So that's my best advice for people who are looking at new construction and, you know, presented with a preferred lender thing. You can use whatever lender you want. And I think I saw a stat like 73 or 77% of people use an outside lender, probably because they can get a better deal. But you have to compare, and you have to get a written loan estimate from them to be able to go take to a mortgage broker and say, hey, Matt, what do you think? Right? You go to greatmortgagebroker.com, you fill out the form, you say, hey, I'm in contract on this new build. It's closing on March 25th. Here's what they're showing me. And a great mortgage broker is going to be able to tell you, okay, even with their credit, I can beat them by $5,000, or you're better off sticking with them. But they offer the incentive, Jay Homeboy, in my opinion, because they want to keep it all in house. And really, if they bake it in, then offer it, it's no incentive at all, right? So why not, you know, get the loan if you're Lennar Mortgage LLC? Get the F out of here, Lennar. Anyhow, I did so good not mentioning names, and then there I go. Joe, this is a great question. Do you think we'll reach a point this year where the spread between ARMs and fixed rate loans will make it worth it for some to choose ARMs? I don't think so. those things haven't priced well for a while. And you'd think that if rates went up, maybe they would. The problem is probably, Joey, I don't even know, to be completely honest, why, it generally has to do with secondary, what's being bought on the back end. And maybe that's just not something that's popular to be purchased on the backside. A lot of times, I guess those things they probably have a shorter life. They probably get refinanced out quicker. And so maybe that is a reason why they're not going to offer better terms on those. But yeah, jumbo arms made sense for some. Conventional arms that just like the spread was so small between arms and fixed, you were going fixed. I think that's exactly it, Joey. I think that they just, and that's a reason too why I was talking to somebody about the spread, between, call it 6.75 and 5.99. You can get to 5.99 for almost, no cost, for less than a point, where 6.75 might be par on some scenarios. And the reason they do that is they want you to write 5.99. They want the consumer to choose 5.99 because it's much less likely to get refinanced. If somebody writes a loan at 6.75 and rates get to 5.5 3 months from now, this thing's going to be paid off and it's worth less, right? And so the rate stacks are going to support that, and the rate stacks are going to push somebody towards a lower rate that's less likely to get refinanced. Because on the secondary market, to the people that are buying it, you buy a mortgage instrument that's paying interest every month. You don't want it to be paid off in 9 months and refinanced. Alex Rodoni. Yeah, I mean, it's funny too. If somebody needs to do this, and I don't think anybody has, Diana Olick from CNN or CNBC, wherever she's on, like she's literally been calling the crash since 2014. Somebody needs to make like a remix of a decade of crash, like this. She's been calling it since 2014. It's going to be interesting to see how it gets spun. There's going to be some outliers, right? There's going to be some markets that like exploded. They're going to draw back, but like a lot of stuff I'm seeing now is like we hit the bottom, and people are like, wait, what bottom? Like, I haven't seen any price reductions yet. Well, if things were getting bid up and this $500,000 house got bid up to 575, 580 back last May, rates were lower, spring buyers were out, and now that same house is selling at 495, like peak to trough, it's a 20% drop. People are like, holy moly, or close to it, right? Whatever percent that is, it's probably 17-ish. And in some markets too, where the median got really high last May, and like, year over year, it's down 9% or down 4%. But then from peak to today, it's down 15, 17, 22. Like that's a huge drawback. And by some people's accounts, like that may be it. Might just be, it's slow moving and steady and flat going forward, but we're not going to see anything fall off a cliff. That would be a big disappointment for all of these crash brothers. And we'll just say, sorry, guys. All right. Let me talk about first-time home buyers in 2023. To your point you made earlier, Joey, the LLPAs, if anybody missed it, I talked about loan level price adjustments coming to conventional loans. Really, really interesting stuff. If you missed my video on good news for first-time home buyers in 2023, go check it out. I tried not to get too granular and too nerdy in it, but depending on down payment, depending on credit score, depending on all the factors that determine what interest rate you get and what adjustments there are to the rate, Fannie and Freddie, otherwise known as conventional loans, changed that whole matrix, and it's set to be implemented May 1st, 2023. Those who have heard me say it or that know that just because It's not implemented till May. Doesn't mean it's not going to hit the rate sheets before then. I don't know. I might be dreaming, but I feel like I've seen it in the rate sheets. I price enough every single day in different loan buckets, and I'm like, you know what? Does that seem like that 20% down got a little more expensive today? Long story short, I'll let you watch the video. Some buckets got more expensive and others got cheaper. The area where you can really see loans getting cheaper is in the bottom right-hand corner, which is higher on the loan to value, meaning 3% down, 5% down, 10% down, so lower down payment, and lower on the credit score buckets, 620 to 640, 640 to 660, 660 to 680. So if you've got more challenges on your credit and you've got a lower down payment, you are going to see loans, conventional loans at least, get cheaper for you over the coming months. Now, it's not going to be that they go from 6.5% to 5.25%, right? But it's going to be where you really saw an impact to your rate because of those compensating factors. 3% down, you're buying a condo, you're a 627 credit score. Those factors might have pushed you up relatively high on interest rate. Now, with those buckets coming down in loan level price adjustments, it just means, you know what? You're not going to get hit as hard. You're still going to be able to get a decent rate, a lot closer to the rates for the people with great credit and 30% down and things of that nature. So look out for that. I've said it before and I'll say it again because I really think it's coming. I really think FHA is going to do something because conventionals made their move. Now it's time for FHA to say, you know what, 0.85 as a factor for mortgage insurance. We want to help more FHA buyers. I mean, that's their freaking mandate, right? Is for affordable housing and helping, owner occupant buyers get into a home. Lower that thing to 0.5. Imagine if FHA lowered their mortgage insurance, cut it in half or something. Somebody that was going to pay $300 a month in mortgage insurance now pays $150. That would be helpful. So FHA, call me. I got more good ideas for you too, if you do call me. Okay, so there's that. I mentioned earlier, Fannie desktop underwriting. Fannie Mae automated system. When you're getting approved for a loan, and this should always happen before you actually submit and get in contract, but different lenders operate differently. We're going to run your file through desktop underwriter, loan product advisor, LPA, one of these automated underwriting systems that's going to tell us, yeah, approve eligible, good to go, or no. It's going to take everything into account, your credit score, your loan to value, and basically going to spit out, yeah, they're good, 5% down, they've got good credit, they've got the down payment and reserve funds in their assets sheet. Like, it's going to analyze everything, and it's going to get tougher, which we had an internal talk with my team today. It's not a bad thing, right? If you've got 3% down and you've got 605 credit score and you're really stretching your budget, right? And you're at like 45.92, 48.63 debt to income. If the automated system says refer, ineligible, it's basically saying, I'm worried about you. I don't think now's the time. Or we got to do something different, right? You got to have more savings, got to have more reserve funds, or maybe you got to put 5% down, or maybe you got to work on your credit and get that up to 640, whatever the case may be. It's not a no for forever. It's just it's not going to work as currently structured, right? So a great mortgage lender can help you restructure that, get you in better mortgage shape to be able to qualify, but that's coming, which at first I thought to myself, man, that's kind of like the opposite of, hey, we'd like to help more low to moderate income buyers with challenge credit getting home. And then it's like, oh, by the way, we're going to make it stricter with our underwriting systems. But anyhow, that is what's happening. That update is taking place on February 25th. over the weekend, those systems get updated. And so it's an algorithm. It's not like they're looking at applications going, yeah, Rosie seems like a nice gal, approved. You know, Johnny, no. It's all automated and it takes into account all the factors. All right, what kind of questions we got? Keep the questions coming. I will say that when you ask me to make a video, I love making videos that have been requested. I got a couple different requests for a couple different things that seem to be in high demand. Assumable mortgages, I'm going to make a video on that, even though you're not going to like what I say about it. It just doesn't happen that often. And then buying a house with an ADU. I'm working on the ADU one this afternoon. I'm even going to collab with a construction guy who I know who has built a ton of these ADUs. And so ADU video coming, assumable loans coming, all of this stuff in the next 2 weeks. Any video you want to see, let me know. If Joey G asked me nice enough to like talk about the future of the Oklahoma City Thunder, I might even find a way to work that in, right? But for all the support of everybody who spends their time with my ugly mug every Monday or by watching videos on the channel, I'm happy to make videos that you guys want to see. So keep the ideas coming. Okay, who do you think could benefit the most from the LLPA changes? I think that qualifying for a home ready, home possible, the 2 to 4 unit purchase could benefit the most. Yeah, I mean, that's interesting, Joey, because like, you know, when you're limited by the home ready, home possible income limits, like how many 2 to 4 units are available that you qualify for with that income? Because, you know, especially with some of the lower down payments, like, dude, it's going to be a qualifying issue more than anything. I mean, I guess there's going to be some parts of the country where you can buy a triplex for 162. Nowhere near any of the markets that I'm walking through, right? But you could be right that is going to be some folks who benefit. Let me see if I could pull up that chart, because I'll bring it back up just so anybody who hasn't seen that video can see kind of what we're talking about. Marketing assets. Where did I put it? Here we go. All right. So like I was talking about, there's these loan level price adjustments. Let me zoom in, baby. There we go. Zoom out. Okay. Share screen. Ba-boom. Now get my mug out of the way. There we go. So this is not the one that you'll see on Fannie and Freddie's site. This is one that a friend of mine put together. Shout out to my boy Andrew Cady, where it's not showing you the current loan level price adjustments. It's showing you the change. Orange, it got worse. Red, it got better. So like I was talking about earlier, if you're 10% down or less, this is 10, this is 5, this is 3, and you're 679 or below in credit, these bottom 9, all 9 of these all got better. And look what happens if you got a 620 to 639. 5% down and 3% down just got 100 basis points better. That's what the red means, and the negative 1.000. It means they got better or they went down by 100 basis points. If I looked at the current sheet, I can't tell you off memory, but you know, if it was 275 basis points of a hit for that, now it's 175. 100 basis points generally translate to about a quarter in interest rate. So it got 0.25% better for these specific buckets. Over here where we got 1.25 worse, this is 720 to 739, 20% down. And I know that there's conversations and a little bit of flack for you're taking from the people that can put 20% down, have a 720 score, and you're making it better for the lower scores with lower down payments. That doesn't make a lot of sense, but that's part of the mandate, right? Is making it more affordable for the people who need it the most. Don't shoot me. I'm just the messenger. So that's some of those changes. And I guess to answer your question, Joey, like, who do I think is going to benefit the most? It's going to be is that 375 up there or 875? It's going to be those low to moderate income borrowers because that's who they're targeting. That's my 2 cents. All right. Yeah, this is a good point, Alex, and this is something that I'm going to talk about. I talked about this with my buddy. We're gonna go like to one of his job sites, I think, and talk through it there. People vastly underestimate what it costs to build an ADU in most parts of the country. You want to build, a 2-code ADU, and you're like, yeah, for sure, I got a big lot. I'll put a 1-bedroom, 1-bath, 800 square feet ADU on the back. I'll be able to rent that thing for $1,600. And then you realize, like, between all the permits, the solar's got to go on the roof because it's a new build. The plumbing, the electrical, you're in it $225,000, which in some areas where you might be able to rent that thing for $3,500, $225 would be cheap. And the houses in that area might cost $1 million. But, in most parts of the country, and even, where I'm living at, like, I couldn't justify spending $200 to $250,000 to build something that's going to generate $1,500 to $1,700 in revenue. It doesn't make a lot of sense. So to your point, yeah, garage conversions. If anyone hasn't heard of a garage conversion, the hack is you take a space that's currently a garage, and they can convert it. They got to do a kitchenette, and they got to do some other things to it to make it, an official accessory dwelling unit where somebody else could live. And that way, some people are doing that, and mother-in-law quarters, Airbnb rental, long-term rental, whatever it is, that garage gets converted. So it's called a garage conversion. Pretty good name for converting the garage. Yeah, I haven't seen one of those heat maps for the cash out refinance, even though cash out refinance definitely is going to see a lot of orange, a lot of worsening. So yeah, if I get a hold of it, flash a light, I'll share it somewhere on the YouTube channel. I don't currently have the heat map, which, right, like the difference between the old and the new LLPAs. So we're going to see. All right, fire away questions if you got them. If not, that's about all for me today. More mortgage demand. We're seeing it's wild. We're getting more applications week after week after week than we've seen since probably September. So buyer demand is back. Rates are down a little bit. People like the fact that they can still negotiate price and credits. I just don't know how long that's lasting. And I'm not a salesman. I'm not going to be like, no, you're not going to be able to get credits in 2 months. But if the way we're going, the way we're trending continues, and demand keeps piling back into the market without more inventory coming on, it's going to be tough. Sellers are going to be able to, stand their ground a little bit more than they are right now when it comes to providing concessions and seller credit. So stay tuned. Let me know what you want to hear. Coming up on March 6th, which is 5 weeks from today, I'm going to have Ryan Lundquist, local appraiser and market analyst, on the channel. If you're in Sacramento, 2 days after that, I'm going to be holding a live event this Wednesday, February 1st. If you're in Sacramento and you're a real estate agent, I'm holding a live event on how to better serve real estate investors. February 15th, I'll probably extend this to everybody. Have Your Best Year Ever Tony Robbins event that I'm going to be hosting and inviting my team, my real estate agent partners, and if I understood correctly, the more the merrier to this Zoom event. I'll be doing an in-person viewing of it, but unlimited people, from my understanding, can join on Zoom. So I'll provide all the details to that. If you don't follow me on other socials, go check out Matt the Mortgage Guy UM on Instagram, Matt the Mortgage Guy on TikTok, Matt the Mortgage Guy on Facebook. I'm all over the place, and I know that we'll have information on all that stuff coming up. Mikey Mike, my project took 11 months for plans to get approved, so be ready to pay up to 16 months on the cash out refi without returns. Oh, did you do a cash out refinance and then you're funding an ADU? Man, that sucks, dude. Are you in California, Mikey Mike? Because it's funny, they talk about how it's gotten easier, and from people I've talked to, it hasn't. It's more California crap that you'd expect, where it takes forever. You know what, Alex? I'll look at U-Haul data, because that's really fun stuff to look at. U-Haul data. I know there's mass exodus from the Bay Area, and of course Sacramento's closer, so we're going to get more people Bay Area to Sacramento than we get Bay Area to Austin, Texas. But people are fleeing in droves. Some are landing in Sacramento, some are landing in Texas, some are landing in Florida, some are landing in Reno, Nevada, wherever. Those folks end up landing. We get more than our fair share, but it's mostly due to demographic. What's another interesting stat I saw, Alex, was last I looked at it, and again, I'm generally talking to people and I'm not so ingrained in the numbers. Mass exodus from Bay Area zip codes, but then you look at the zip codes they land in, and there was more Bay Area zip codes. So sometimes it's like you move from here to Daly City. I don't know all the different parts of the Bay Area, but you move from South Bay to this other part of the Bay Area. You move from here to the other part. So it's not necessarily like they're getting out completely. Maybe they got to wean themselves off of whatever the heck is holding them in the Bay Area. But anyhow, thanks for watching. Appreciate you guys. Until next time, we gonna see.